There we go.
Great. Okay, so what we will do here is, I will. So today's meeting, for everyone who's listening and who's going to do this later on, this is a little bit of a different session. So I'll give James a sec. Alex, if you give me the ball, will it still record okay?
Yeah, should.
Okay. Hey, how are you?
Hey, I'm doing well. Yourself?
Good. Always feeling good, man. Always feeling good. Great to have you. Thank you for joining.
Oh, I gave it to Jay.
Perfect. So everyone who's on the phone, well, Matt and James, and anyone who's watching this afterwards on recording, thank you very much for taking the time. Gentlemen, thank you for being in the room. So last time when we did the Excel, we had a pre-formatted sheet, and, very reasonably, Alex was asking, do we have a workbook for today? And, I've done this different ways over the years, but I found that this facilitates better memorization and understanding of the material if we do it in a way that doesn't have a pre-formatted workbook, and I'll tell you why. So this and Thursday session, aim is to cover two things. So today we're going to cover corporate finance and understandings of what corporate finance is, its two primary elements, and how we think about corporate finance and best practice in corporate finance. On Thursday, we'll take elements that we've learned from today's session, and we'll actually do some financial statement modeling and try to think about some aspects of that. For both of these sessions, you can imagine, even though I'll divest to cadets the material, both of the topics could easily be like weeks-long courses and all these like programs they have like Beat the Street or whatever. They have people come for 18 sessions and teach all that stuff. So what I'm trying to say is there are a few essential elements that I want to try to impart, I would say my take, because these are things that have been codified over decades, but I want to try to give my slant on which parts I think are maybe more applicable and important, based upon everyone's interest and also relative levels of comfort of what everybody already knows here. We might spend more time on one section or less time on another. Also, as we go through these concepts, right, for example, something will come up on not too far into the session, hopefully, which is looking at financial statements. As you know, a copier, I could have printed out some financial statements for, IBM. We could have done it, but I feel like you remember it better in a practical application, because if you're sitting at your desk, and, that concept that Amir mentioned, how do I do this, how do I look it up, you won't have it there, so I will, in some cases for some of this stuff, we'll literally pick something at random, and we'll go to a random site to kind of make the point. There's not like one site you need to go to. This stuff is all general, well-described information that can be found anywhere, right? Okay. So, with that in around, well, I need to show my screen, of course, all right. So I'm going to show my screen for people who are on the phone and are going to watch this later. If I can, I will pull up this stuff on screen. So let's go into my sent mail. Okay, so we want to start with these questions around corporate finance, why should we care, and what are ways in which we use analysis around corporate finance to gain something from this subject and this discipline. So, at its most base, and I'm writing this just on the board, but for those of you, again, listening, I'll describe everything I'm writing down. So if you think about corporate finance the way I think about it, this goes back to standard financial theory that is around the Great Depression in the United States, right? And what you remember is, there never used to be professors of finance. All the original financial people were all economists who had crossed over, right? So a lot of the things that we're going to talk about are traced back to statistical and accounting and capital concepts that would have come over from economics. So if you think about corporate finance, I would split into basically two categories. One category is how we think about capital structure, and I'll explain really what that means. And all along, as always, jump in with questions, because we're going to cover a lot of stuff, and I neither, at both ends of the extreme, mean to be patronizing if this is something someone already knows, nor talk in an infantile way if it's something about which you have no exposure. So you bring me back to the right level of what we're talking about. So on one side, we have capital structure. What do companies have in terms of their capital structure, and how do they make capital structure decisions? What's the way that they have their capital structure in place, the way that they raise money, the way that they spend money, the way that they capitalize themselves in the future? And the second one is, how do we use analysis around finance and around capital structure to make better decisions as an organization? So if you keep two words in your mind, on one side I would maybe have the word structure, and on the other side of your mind I would have the word analysis. So to start, let's maybe put some concepts on here of what these things mean at a 30,000-foot level, and then we'll start to peel them apart. So it's about a company that exists, public or private, and what are some parts of the capital structure that might define the valuation of that company? Anybody?
Assets.
Very good, very good. So you have assets, that's one possibility. What might something else be? That's right, I'll fill in some more than myself. So assets is very good. Sorry?
Debt versus equity.
That's hot. All right, so we have debt versus equity. And you know, as companies go on, there can be other things, right? So within assets, you could have cash. You could have assets that are non-cash, right? So if you think about a company's valuation, you can either have assets which have some type of exchangeable value. On the other side, which, you know, I'll explain what this is, how it goes, but this is going to be an introduction to what we call the balance sheet financial statements, but we'll get there. You have assets that have an exchangeable value in terms of the ways that you raise money or the obligations that you owe to other people. Traditional balancing act that you have to do is between debt and equity. So I want $1,000. I go out to the market. I can either say, you know what, I believe that my company has some inherent value that you would enjoy owning some part of in the future. So I'm going to give you, let's say I want $1,000. I could give you $1,000 in stock. In its simplest form would be equity. Or I'd say, you know what, I want $1,000 from you. I'm going to go to, I was going to say Kendall Bank, but that reference is 45 years old. So I would go to Bank of America, and they didn't have the first ATM though. I could go to the bank and I could take out a loan, right, or a bank note, and I can say, you know what, I want $1,000. I'll pay you 6% a year if you lend me the money. So I could get the money through debt. A big part, I would say all, but a big part of everything that is done in corporate finance can be boiled down at its essence to how do companies raise and preserve their assets, and do they do so through debt or equity? And the ways in which they think about balancing these things, what is most prudent for that particular company and what they're trying to do. Does that make sense at a conceptual level to hold on to for now?
Yeah.
Okay. The second part is analysis, right? So on the other part of the equation, we're thinking about what we do with this information, right? The other part of corporate finance has to do with how we think about valuation and execution against these assets. So think about, for example, you're in New York City and you're a stock trader, right? So you're sitting down and you're looking at various things, and you see that a stock is valued at $75 currently in the market. That's what it's trading at. And you want to know, should I go long on this and buy this, or should I sell it? Well, how do you come down to an inherent valuation of whether that stock that's trading at $75 is actually worth $90 or whether it's actually worth $60? One example. Another example. You look at a company and you have all this information about the company's assets and debt and their cash and like their income. Is this company a strong company or a weak company relative to their industry? So one was like valuation. That's a big part. And another part is, again, just traditional analysis. Or sometimes we call it ratio analysis. So basically, if I produce and have a company's capital structure, how can I use the information that I have from that to make decisions and understand the valuation and financial position of companies? That is corporate finance. Any questions? Great. So that's the 30,000-foot view. Now, point 2, forms of business organization. So, before we go any further, I want to make a few distinctions because these are important before we look at financial statements. And I just want to spend most of our time today, this is not an accounting class, otherwise I could bore you all to sleep in either tax or financial or managerial because I'm very passionate about all three, but I don't want to give you naps until later. So, I need to clarify a few things so we understand when we look at the financial statements what we're talking about, right? So let's talk about basically 4 or 5 categories of organizations. Now, I'll put these on the board. For those on the phone, I'll say these aloud and you can take note of them. So number 1 is what I would call a sole proprietorship. I'll explain what all of these are. And again, there are more subcategories, but I'm trying to simplify. The second that I would call is an LLC or an LLP. Third one is, I would say, corporation, or if you like, S corporations as well. Again, I'll explain what that is. Non-profits. And some people within nonprofits will break that down further between traditional nonprofits and governmental organizations, but let's just say there's a wide range of governmental and nonprofit organizations, whether it's hospitals, schools, government, and so forth. Okay? So, why am I bringing up these organizations before we go into financial statements? Because you saw in our 30,000-foot view, right, a big part of corporate finance is ocean. So whether you think about any company, right, as we said, assets are basically what you have, the material possessions and worth that you've created. Its representation is either represented in debt or in equity. Whether it's debt or equity, the debt or equity both represent ownership. In our company's case, it's basically Andre and Rathmia, right? If it's a public institution, it may be held by the state or the city or something like that. Now, traditional 4 types of organizations that we look at and why they're different by ownership type is the following. So let's take a sole proprietorship. So let's say Alex opens a watermelon stand, right? And he goes outside the building and he's, hawking seedless watermelons to like all hungry passersby, right? That is a sole proprietorship. So I'll put Alex's watermelon. Right? In this case, there is no sophisticated capital structure. Alex basically went and bought watermelons. He has a business. He's selling the watermelons on the side of the street. If he makes any money, that basically is equity, although he may not think of it as that, and he puts that in his pocket. If he has any assets, whether it's a stand in his watermelon, it's his. If someone comes in front of his watermelon stand and trips on one of his watermelons and breaks their leg and sues him, he has to pay out of his pocket if he ends up getting sued. So in the sole proprietorship, one or small number of people own a business, there is a relatively unsophisticated or there is no equity structure and there's no legal protection for the organization. So it makes things simple but also complicated because you're taking all the risk. A LLC, a limited liability corporation or a limited liability partnership, things become a little bit more sophisticated. So instead, let's say all 4 of you put together a business together, and now you have, the Wellesley Beam Fruit Company. So now let's say you guys had a warehouse, and you were selling fruit to anybody who was a reseller, like Whole Foods or something like that. Now, you have public shares. It's not like you're traded on the NASDAQ exchange. But on the other hand, it's not one person hanging out on the corner by themselves. As a result, what people do in a limited liability corporation or limited liability partnership is they create an organization that is a legal entity, and all of the assets and liabilities and income production and so forth that organization has goes into the limited liability corporation or partnership rather than belonging with any individual. So, as a result of doing that, you protect yourself from legal issues, but it also can create other issues in terms of taxes and the ways that you have to pay taxes versus being individual. So, that's kind of an in-between organizational structure. Next, we have corporations and S corporations. So for corporations and S corporations, under LLC and LLP for those on the phone, I'm writing, legal protection, basically, which is basically what it is, and tax implications for an LLC, LLP. Corporation or S corporation, you now have shares. Now, people often think with corporations, this is only places like Kellogg and stuff like that, not necessarily. I'll give you an example. My father was a physician for 35 years, and he ran a medical practice in Connecticut. That medical practice was a corporation, and it had shares, but the shares were only owned by certain members of the medical practice, some of the office staff, some of the nurses, some of the physicians. The idea behind that, which often happens even in, for example, legal and medical practices, is you have the legal protections of an LLC, for example, because of malpractice and things like that, but on the other hand, because it's a partnership, you have an opportunity in a more sophisticated way to divide shares between people in the organization. The traditional classification that people often say is, if your organization is less than 40 people in size, you would traditionally roll up into an LLC or an LLP. If you were like at about 40, you would become an S corporation, and you were very large, you would become a corporation. In reality, the organizational structure in the middle is a little bit blurred between the two, depending upon what you're doing. But I basically want to get across the point to you that there are three slices of organizations and they matter. Do I have no protection and ownership, formal ownership structure at all? Do I have some type of stock or partnership or ownership structure like an LLC, an LLP, or a corporation? Or in the third category where I'm a nonprofit. So the reason we tease out nonprofits from these other organizational types is, think about if you're General Electric, right? So if you're General Electric and you make $1 billion in a year, right? That's a big windfall. You take the money, you put it away as equity, and maybe you hold on the asset side of your balance sheet as cash and so forth, and the idea is you make a lot of money, you put it aside for other things next year. Maybe you just hold it back to be safe, maybe you give it back as a dividend, maybe you make an acquisition, so forth. The point is, in corporations you can do that. You can hold on to excess profitability and you can use it for future business activity. Believe it or not, you actually cannot do that in nonprofit organizations. And that's why in nonprofits, they actually don't have a concept of shareholders' equity. They have a concept of net assets. So like if a hospital, for example, makes an excess profit of $100 million at the end of the year, they are not allowed to hold it as equity for the next year. They typically have to spend or allocate it to other parts of their mission. Okay? So those are the three organizational types. Most corporate finance, as we think about it, it goes with everything here on the right, except for like sole proprietorships and stuff like that, because most of it is focused in the center, because the meat and potatoes, how you do financial analysis and capital allocation is most interesting there. But of course, hospitals also have financial statements and make all the same types of decisions. And even if you're running a lemonade stand, you may not have stock, but all the traditional things like having a balance sheet and having an income statement is of course creatable and usable and important. So those are different types of organizational structures and how they differ. Any questions? Moving nicely here. Now, let's talk about financial systems and markets, and then we'll go into financial statements. Now, if this is like the nature of everybody here, I feel like I need to say less about the goals of financial management, but all I will say is that when we hit financial ratios and we go to financial statements, right? Some of this stuff is pretty obvious. We obviously want to something obvious, right? So every organization has to ask itself, what are our financial goals, right? All I'll articulate in a minute is, some organizations prioritize the top line. They want to make as much bookings or revenues as possible. Some organizations want to maximize profitability. They don't care if they make $100. What they care is after they pay out all their expenses, what's left. Some organizations maximize cash flow. Some organizations, that are startups, for example, say we don't even care if we're making money, and we don't care if we make cash flow. All that we care about is customer acquisition. How many people are in our ecosystem? So, needless to say, organizations can have very different financial management goals, but I want you to think about, as we go through the financial statements, what is each organization's goal? And as we look at ratios and financial statements together, how would you think about those goals differently and gauge whether you're reaching those goals based upon what your objective is? That's all I'll say on that. Let's talk about a financial system. Okay, it's going to be fun. You think about draw this fast. Actually, you know what? I want people to see this on the cover for this one, since it's not just lists. So I'm going to try to draw this in Microsoft Paint, and you discover, as Clarence did, that no talent at art. Here we go. So let's do this. Bob Ross on this shit. You guys ready? Okay. Okay, so here I would think about things. So, in terms of financial institutions, and we'll talk these a piece at a time, we have the banks down into two flavors. Commercial and investment. So up, and what we mean by that, okay? So, think about banks and their role in the financial system. They do many, many different things. I'm going to explain to you the classic definition of banks and also give you a little bit of information about kind of financial history. So, in the traditional world, commercial banks always were in the business of basically savings and loans. So you go to America, obviously, you go to a branch, you put in your money in deposit, you get a CD or other such variables, they lend out the money to other financial institutions, they basically call it a day. They can do auto loans, they can do home loans, they can all do all kinds of that stuff. On the investment banking side of things, brokerage activities were always exclusively, traditionally limited to investment banks. So, investment banks would issue equity. They were the ones who would execute against trades, do sales and trading and stuff like that. They're the ones who would help with financial management. So the idea that you would go into like a Bank of America and also put in your deposit and also talk to the little guy at the desk who tells you where to put money into mutual funds, that's a relatively modern concept. What is perhaps even more interesting? So if you go back to financial policy, factors that led to the Great Depression were because there weren't very clear and understandable delineations between who was responsible for what. And as a result, because excess speculation and everybody wanted to make a quick buck, in the 1930s there was a Great Securities Act that basically cleaved commercial investment banks in half and made clear that there were some activities that the commercial banks could do and some that the others could do. Now, in 2001, 2002, there was the Graham-Bliley, I believe, Modernization Act. So under pressure from the banking industry, the banks didn't want to have this, forgive the term, but this is actually what's called in the industry a Chinese wall, and they didn't want to have this division between the activities of commercial and investment banks. You knew whether the motives were good or bad, but they were acting in their self-interest as an actor in the financial system. They wanted to make more money, because the idea from the banks was, well, it would be a lot better for everybody, and in parentheses for us, if we take deposits on the side of our organization that's Citibank, and then we could take the money that we have on Citibank and invest it in things on the side that's Citigroup, and where we have Sullivan Smith Barney and we have investment banking services. Now, on paper, I think there's a lot of potential for that to have a lot of benefit, but of course, I think objectively, even though it enhances the profitability of many of those organizations, it certainly creates a lot more risk, and that's why you've seen things like housing meltdown and, Lehman Brothers and so forth and so on. So, I'm going to pretend that the commercial investment banks don't function the way that they do after the modernization in the 2000s, and that they're separate functions. And then we can put them back together, which is the reality of how they function. But here's basically what happens in the financial system, right? So let's put in different actors here on the map as well. Whoops. Let's draw here. Corporations. And here, explain all of these are rating agencies. Regulatory agencies, the public, and subscribe broadly. Okay? So now, we're going to start connecting the dots and understanding what the interplay is between these organizations. I also should probably put markets here, which is not an entity, but is probably something we should delineate as its own force. Okay? So, we'll start connecting lines between these, and I know you guys know a lot of these, as I said, but hopefully can add a little bit of color that might be interesting as well, right? So, in each of these first, so we understand what they are, and then we'll talk about the interplay, right? So in terms of regulatory industries, you have like the SEC, you have other organizations like that, which basically serve auditing functions on the financial performance of entities. Now, a little bit of an oversimplification, but I always think of regulatories and agencies and things like the SEC is all the stuff that we talked about with corporate finance, how it's all based upon information about companies' capitalization and how they finance themselves and so forth. The SEC's job basically is to make sure that all the information that companies publish to the market is accurate, well represented, not deceitful, and follows rules of fair and even disclosure. So what do we mean about that? If you're a publicly traded company, the idea is that when you disclose information to people, you need to disclose information to all people under your tent. All are supposed to get information at the same time. So you have you go to the analyst at the Goldman Sachs and you tell them you're going to miss your estimates, and you don't tell the analyst at like Merrill Lynch. You can go and tell your friends at like a buy-side firm. All of this is very obvious, but I think that when you frame it in the scope of it's about having accurate, non-deceitful, fairly disclosed information, that's the job of regulatory agencies. Rating agencies. So I consider this a slightly different function from regulatory industries. The biggest ones of these are S&Ps and Moody's. There's also a third one called Fitch, although it's been losing market share to the two of them. So ratings agencies, this mostly concerns debt. Ratings agencies go out, I should add analysts too. Again, there's some overlap between these. Ratings agencies primarily rate fixed income and debt instruments. Their job, which ironically is paid for by the banks, I don't know if you knew that. So a piece of every debt issue goes to the ratings agencies, and the ratings agencies issue ratings on fixed income offerings and give some type of assessment of what they think the financial health and financial potential of those fixed income securities are. They do this for corporations, they do it for countries. That's the role of rating agencies. So we'll put S&P, Moody's, Fitch. Right. The public. So we have investors, and I'll put their representatives. So of course, the biggest source of capital isn't corporations, it's people, and it's individuals by proxy investing their money largely through mutual fund and asset management organizations. So when you give your money and you give it to, your advisor, you directly invest in securities in one way or another. Of course, we know this, but a lot of people maybe don't realize this, which is understandable. They're effectively entrusting their money to one of the other boxes on here, and they're flowing the money into the system, at which it becomes aggregated, sold, repackaged, and so forth into other firms. Investment firms. So I'm going to separate, although again, in some cases these are joined together now, like, investment banks, some of which have their own internal investment firm arms, but here I'm going to put private equity, VC, and hedge funds. So I think you have a general sense of these, but I'll just give my quick refresher. Private equity firms buy other corporations using a tremendous amount of debt to make those acquisitions. They then pay off that debt over traditionally a 5 to 7 year period, also consolidating and reducing the scope of those organizations, and then they take the profit, pay down the debt, and put the money kind of back in their pocket and pay it back to their investors. Venture capital firms go to traditionally early stage companies, although increasingly it becomes later and later because there are fewer quality early deals. And they have firms that basically have, in many cases, no traditional metrics of financial success, stakes, which give an implicit value to those organizations in exchange for some percentage of ownership in them in the future. Hedge fund, which doesn't really mean anything anymore, used to be contra funds that invested in contrary positions in different industries in order to literally hedge in offsetting positions that would end up making money, but now has become a blanket capture for thousands of firms that basically do buy-side investing that is not regulated within a brokerage structure. Okay? Let's stop there for a second. We've gone through several boxes. Any questions?
Buy-side.
Very good question. Very good question. So when we talk about financial institutions, we often break them down between whether they function on the buy side or the sell side. Now, what we mean by that is, if you are a hedge fund or a private equity firm, for example, you are a buy-side investment firm. What that means is you are not originating or selling any form of security. So when you think corporate finance, or you think finance, after today, think the word security. Because what you really mean is, does the firm sell a form of securitization? So let me take a step back to banks, right? So this is a little bit of a segue, but I think an interesting one. Let me draw another ugly picture somewhere here. Let me save this one. And orgs. I'll open this in a second. So Luke asked a really interesting one. So let's talk about buy side versus sell side. So it's like you were like, how does a bill become a law? It's like, let's talk about how a security comes into being, right? So, in the investment and securities world, here's what happens. I'm going to go through the traditional model, and then I'll tell you how it functions in reality. So you have a organization that is incorporated in some way. It could be a traditional corporation, it could be an S-corp, etc. The organization goes out, and he goes to his investment banker at a firm that has a broker-dealer license, which entitles them to basically securitize assets, okay? And the investment banker is there, or if not an investment banker, they just go to the brokerage itself and pay a very small fee. But basically, let's just put it this way, it is difficult, if not, I believe, possible to securitize assets yourself. You need a broker-dealer to do it for you. So you go to your investment banker, and you go to the organization and you say, I need money, I need a lot of money. And the banker says, okay, let's talk about what you need. So again, we go back to debt or equity. So, make the decision about what you need. Anyway, to short answer your question, Luke, and then I'll explain more about it, this is why these organizations, investment banks, are called sell-side firms, because they are they are the only types of firms within the financial system that are actually directly selling anything, right? Because what happens is, you decide whether you want debt or equity. If you want debt, you're issuing bonds or some hybrid form of which. If you want equity, you're obviously issuing stocks or some hybrid form of that. So then what happens is you decide what you want, and then these securities are created and sold in what is called the primary market. So let me explain what that is. So, I'm going to draw two circles and a line, which is going to be my crude representation of a vehicle of some sort. That was just sad. All right, well, let me write a word here. Roadshow. So, what happens when firms securitize things is they agree with the organization that contacted them on how much money they raise. So, for example, they would say, I want $100 million in debt or billions of dollars in debt. I want to do a $100 million IPO, whatever. Then, in the best sense of old patent medicine snake oil shows, they get together with the bankers and they go on a road show. So what this means in practicality is the bankers get together with the organization. They put together a prospectus or pitch book that basically says why the company is raising the assets that it wants to raise, the reasons for it, what the risks and benefits of that are, and their assessment of what the banker has estimated they think the valuation is of the organization. So one of the things that bankers get paid for is the company comes in and says, I want to raise money. The bank sits down and does his financial valuation, which we'll go through preliminarily. And by the way, for any of you here in the room or on the line or listening to this, if I work with you anywhere, it's a lifetime pass to always asking me anything you want about anything, right? So this is like step one of this discussion, right? So they get together, the banker takes out his pen and paper, he takes out his Excel, and he does the math, and he says, okay, based upon the financials you have, I think that you're worth about $100 million. So the organization, dillies and dallies with them and says, I agree or I don't agree, whatever. Let's say they don't agree completely and they think it should be a little bit higher. The banker looks at the numbers again, they say, okay, 110 million, we'll try for 110 million. They then go to the capital markets portion of the bank. So within the bank, you have traditional bankers who practice corporate finance. Put this over here. And you also have capital markets bankers. Groups like debt capital markets and equity capital markets. Their job is they understand based upon trends in the market realistically, given what's going on in an industry, what's happening in that given day, what's happening in that given week, how the stock market is doing. They have relationships with asset management firms. Now over here, we'll put asset management firms. Now in this case, I'm not going to differentiate between buy side and sell side. So again, sell side would be investment banks. Buy side would be, Vanguard, mutual funds, it'd be Fidelity, all those types of places. So you have asset management firms. What happens is the capital markets banker with this line I'm drawing here, they have a relationship with the asset management firm. So they start calling up Legg Mason, Fidelity, Wells Fargo, all those guys, and they say, I have this company here that makes backpacks, and they have this ripping fresh design, and they want to raise money. How many of these shares will you buy and at what price? They build a book, which means they basically get a commitment from everybody in the asset management firm about how much they're willing to buy at what price. The capital markets banker boils this all down, shares it with the corporate finance banker again in the organization. They decide on how much they're going to offer, and then they go on the road show, they get the commitments, and they have the offering. So after that's been offered, they have the IPO or the initial debt offering. Now those securities are in the market. So what happens? Let's say it was $110 million. The banker gets their commission, let's say 5%. All the percentages have been coming down, but let's just say they get 5%. So in this case, on $110 million, the banker would get $1,550,000, right? So they would take their cut, say thank you very much. $5,500,000. The banker would take their cut. They would say thank you very much. They would put it in their pocket. They would take the amount of money that was raised, less their commission, so they would give $100 million-ish change to the company, say thank you very much, and that's it. At that point, everything else that happens, I'm going to draw a box out here, in the secondary market. So, people don't realize sometimes that 99% plus of all trading that they encounter is happening in the secondary market. You are not buying stock, debt, or any other security in the primary market unless you literally participated in the IPO or in the initial debt offering. That is how securitization happens. And then you have the sell side, which is basically the investment banks over here, and you have the buy side, which is asset management firms. So rather than just give you a short answer, Luke, and for everyone's benefit, the reason we call it sell side versus buy side is the investment bankers originate the securitization and they sell it, and eventually it is bought by the buy side firms or asset management firms that buy those securities either in the IPO or initial debt offering or who continue to buy those assets in the secondary market. Does that make sense?
Yeah, absolutely.
Any questions? All right, let's go back now to where we're with orgs, and I want to check where I am on time. Oh, we're doing well, 2:45. So we kind of, in a sense, have already blown through everything on markets, right? So on you know, we covered everything that we talked about now. The only thing that I'll add to it is there are, of course, different exchanges for different types of financial assets, right? So you have, we talked about some of these already. You have stock indices. You have exchanges. So you have things like the NYSE and the NASDAQ for stock exchanges. There used to be a smaller one called the American Exchange, which folded into the NYSE. You also have, though, things like the Chicago Board of Trade, which trades, commodities. So you have things like, you see trading places, things like orange juice and soybeans and, stuff like that. So you have commodities. But the idea is basically any asset you have, whether it's a stock, a bond, or a has some type of exchange or clearinghouse where basically prices are traded and regularized so that buyers and sellers can meet. Now, increasingly, that has turned almost completely digital. So NASDAQ, National Automated Security Dealers Automated Quotation System, North American Security Dealers Automated Quotation System. NASDAQ used to be very novel because the idea was on indices like the NYSE or like things traded on the Dow, guys literally called specialists, like when you see those old pictures of the stock market floor and the guy in the white jacket who's they're going to give you a pound of like roast beef, it used to be that you had specialists down there, and specialists would match the buyers and the sellers. Now, people argue this on both sides, and of course technology is valuable and usable, but people who like specialists and floor people would say the advantage was the way that we've outlined here how much of the buying and the traffic happens by institutional investors, right? So throwing out a lot of terms here. Institutional investors, makes sense, it is what it sounds like, are institutions like, again, Fidelity, whatever. Individual investors like us still buy their shares through brokerages. But the point is, the vast majority of traffic in the world is done by institutions. They trade enormous blocks of shares and so forth. So it used to be you had these specialists who knew the depths of the market, and they would say, I have this 100 million share order coming in for Apple, and I have these 4 or 5 blocks of these guys who want shares on this side. They would do the market making aided by technology, and some people argue, which may be nonsense, but some people argue that having some specialists on the floor was very helpful because they could do these things with a bit of feel beyond what just machines could do to avoid to avoid upsetting the flow of the market during the day. We've actually gone to the other extreme, which is everything has become so technology-oriented, and there's so much what's called program trading, which you guys might know as all this algorithmic stuff, where, you know, people buy and sell in fractions of a second, that you have things like flash crashes, where all of a sudden the market will go down like 800 points because some like algorithm broke or something like that. So, like it or not like it, markets serve an important role as clearinghouses for financial transactions, and increasingly they have moved towards automation, which has pros and, I would argue, cons as well. You have options, which we don't say a ton more about, but they are in which you have a relationship between agents for that corporation and, you know, managers who run the corporation. You have ownership in those corporations, which, if they're public, is split often between founders of that organization, the employees, and the public. And if it's a private corporation, you know, partners of that organization or employees of that organization. And then you have analysts. So, in line with what I was saying about important parts of financial history, if one that's important for you guys to understand is this idea of the Chinese wall, and the idea that investment banking and commercial operations were separated and then put back together. Another important thing to understand is about analysts. So I think everyone is probably too young to remember when there were separated analysts, but you probably read about it somewhere or you have some knowledge about it. But when I was a kid, I was in like middle school, the like hotshot people alongside like who did M&A deals were the analysts who put ratings on stocks. The reason this is, you might be like, how in the world did allow this to happen? But it happened. You have people like Henry Blodgett, who he was a very famous tech analyst at Merrill Lynch. He's the one who's famous for like discovering Amazon and like Yahoo and all a bunch of other companies. And what would happen is the analysts like Blodgett would go out and they would research the companies, assessment of the ratings and which companies they thought were good and bad, and literally on the same roadshow where an investment banker would be trying to sell the securities, you would have from the same investment bank someone who had put the ratings on the company saying, I have a buy rating on this stock. Now, the bank's point of view was, this is a really valuable service we're providing because this guy's here with us because he put a buy rating on the stock. We're not selling you this because it's not garbage. If it was a sell rating, we wouldn't be out here selling you the stock. But of course, in reality, it's hard to dispute the fact that in many cases, banks maybe moved stocks or securitized offerings that didn't have the ratings, and that a smart analyst would realize very quickly that they would be, you know, dining alone if they weren't willing to give, you know, a few more valuation points on the price or on the rating. I'm being a little bit glib about that, but you can see the conflict. So it used to be, you know, if it was making some huge, you know, 8-figure payday, the equity analysts, the hotshot ones at least, were probably getting it too. I think people realized that was really wrong for many reasons. And in addition to, at the same time that they were putting the banks together, which I could argue was a regulatory loosening, they also did have a tightening that they'd say, you know what, this fact that analysts are rating stocks and traveling around with bankers who are selling them, that's really probably not right. So they established this Chinese wall, at least for the analysts going around with the investment bankers, and they made that distinction. So analysts became less, even though they're still within investment banks, I argue they've been more like external researchers and consultants rather than being one consistent part of the organization. Okay? These are the things, and you know, I won't do all of these because I explained them as we went, but you know, you can look at this picture when you review this video or look upon this if you're thinking back on the presentation. And one way to make sure you feel comfortable about the way the financial system works is you can get any box within this diagram, and you know, we'll do one or two together for fun, but won't do them all, and say how do these connect with one another. So for example, you know, how investment banks and regulatory agencies work together. Well, the investment banks, you know, give financial information to the SEC when they want to put together their financial filings. The SEC reviews the documents with comment to make sure they're correct after looking at the auditor's notes and the financial statements, and that's the relationship between them. One or two more, you know, the public the public take out loans from commercial banks, and they take loans back out. Increasingly, as commercial investment banks are blurred, the banks become one-stop shops where you can go into Bank of America and you can put money into your mutual fund, but you can also get a loan and make a deposit, and so forth. So let me stop there because I know we threw out a lot of stuff. Any other stuff on financial firms, securitization, kind of how organizations interact with one another within the economy? Great. All right. So let's close that. Now, all right. So 4 points. Why don't we take a 5 break, and we'll come back at 2:58, and we'll come back. We'll spend kind of 2 other modules. The second big module is financial statements and financial and ratio analysis. So some teach this differently, but I think, and you guys can give me feedback on whether you like this, I think that it's helpful to have a little bit of a sense of kind of how everything fits together. Because now when we look at the financial statements and I tell you what they are, how they interrelate and so forth, you can put it in context of like, so what? Or like, why would this person want this information this way and so forth and so on. So that second module, financial statements, ratio analysis. So in effect, we'll split again into those 2 halves. One being, what is the capital structure of organizations and why? That's financial statements. And the second one is going to be the analysis part. Well, so what? And what do we do with that information? The final module, if time allows today, will start to take us further into the advanced parts of analysis. So Benjamin Graham, who's the father of securities analysis, who like Warren Buffett idolized, and he's the one who came up with the ideas of value investing, and it's the standard book still used in financial classes, both the undergraduate and graduate level. He came up with these ideas. Well, he further codified and made usable these ideas of how to value securities and organizations using concepts of time, which again came from the economic world. So that's the third module, okay? So let's take a little break, and we'll come back at, let's say 3. But when we come back at 3, we'll the whole way. Okay? All right. You still there, bud? Matt, still there?
You're there.
Oh, terrific. Terrific. Okay. Well, it's a nice break, and you guys got my juices flowing there. So just take a swig of this. Now this is going to get really interesting, guys. So I appreciate the energy and attentiveness, because seriously, I feed off of it. So maybe at the end we'll play a level of Cuphead together. All right. So here we go, gang. So okay. So we framed capital structure and the idea of analysis. We've looked at types of business organizations, the goals of financial management, and we did our little mappings of how securitization happens and how the financial system works, right? And how markets work. That's all great and good, but you probably want to know, well, how do I get into the details? So let me ask Kieran, if for those watching this on a re-record, you can kind of ask yourself this question. Level set for me your guys' level of comfort with financial statements. So if I say balance sheet, income statement, and cash flow, does that kind of sail over your head or a little bit of familiarity? Either is totally fine. Some familiarity.
Yeah.
Good. Okay. So I'm going to pick a company at random, look up a financial statement, and we're going to start our discussion, okay? So companies articulate their financial position through filings. The filings are audited representations of financial performance and position, sometimes over a period of time, sometimes a place in time, frozen in time. The most common filings that come up are, and you've probably heard of some of these, companies file 10-Qs quarterly. Those are quarterly financial statements. They also file 10-Ks, which are annual statements of performance. sometimes 10K is published as part of what's called the annual report, which I'm being like a little bit geeky, but it's basically a bunch of like colorful marketing stuff, and then you know you've hit the good stuff when you get to like the toilet paper, quality paper in the back that actually has the financials on it, so that's the annual report. 8K is a filing of important information. So let's say a company signed a really big deal, or like they had a major product launch or something, or a major figure in their company left or something. The company might file an 8K, which is a disclosure of a material event. Another thing to note is, in the U.S. system, we've gotten used to this canonical idea that we record and report financials on a quarterly basis, but that's not true in all of the world. In fact, in Europe and many other parts of the world, they only file their interim financials twice a year rather than doing it every quarter. There are, again, pros and cons about what that is. I think people in favor of it would say that the benefit of doing things on the twice-a-year basis is managers aren't always managing to a number, they don't have so much pressure and stuff like that. On the other side, people would say that the quarterlies are better because you get more information more quickly. So if anything you can't win, there's kind of pros and cons. Okay, so those are the big statements. So now, let's go into the company filing. So, in addition to pulling these, I'm going to show you guys how to do this. So in the future, you can do this yourselves in practice. So all you do is, you go to sec.gov. You only have to remember 7 characters. sec.gov. Once you're there, you go to company filings here, and I tell you, one of the reasons I became, and I love so much, and I hope I can impart some of that love and energy to you guys for finances, I always loved the idea of my mother-in-law, for example, is a physicist. Wonderful, wonderful guy. A lot, very, very cerebral. And, you know, he would always say to me that one of the things he loved about physics, and I'm taking this from him to use here, is when you work in theoretical physics, right, you need anything, right? You know the information. You sit down with the information and you can do anything you want. Now, in reality, that's more complicated in 2018 because companies are increasingly complicated, and a lot of times there are details and things that aren't there in the financials. And if it was easy as just pulling out the financials and analyzing and knowing what to buy, everybody would be a millionaire, right? But you're not thinking about things in terms of like investing, which is a lot more complicated because you're dealing with like a market. And instead, you're just much more personal and local of, wants me to look into this question, or Brian Duffy wants me to look into this question about Veeam's operations. You basically you will have all the tools you need, your financial analysis skills and the company's financial statements. So I think that's kind of a neat way to think about it. So let's pick company. Anybody in the room or on the phone, give me a well-known large company. Great. Oracle, pick. All right, pick Oracle. So now, here's where a little bit of the magic happens. So you look here and see that we typed in Oracle. One of the challenges that you learn how to do is you just SEC list, and Edgar is the depository of all filings. So now the challenge is going to be, right, if you typed like Apple, or if you put in Oracle, or some word like that that wasn't like very, very specific, like the company with a very, very specific name. What's the...
VMware.
VMware, yeah, or what's the, I was thinking of Lululemon, yeah, VMware is good too. If you put in like Lululemon, you'll get one match, you look it up, you have a happy day. If you put in something like Oracle, part of the challenge becomes, Oracle is a particular name. So you're going to get some things like Oracle Beauty Brands, Oracle Global Healthcare, etc. So, to look it up is 2-3 things in concert to make sure you're looking at the right company's financials. One way, which could be I find always going to the SEC the easiest. Everything is going to be there, whereas if you go to a company's website, sometimes they're selective about what's there, and if you don't know what it is, and so forth. And all the notes are always going to be in the SEC too. So, let's look for Oracle. One, a really big company that is publicly traded, an SIC code, which you see the SEC tries to help you for some of the terms here that are more acronymish, and you'll see this is a standard industrial code. Company that's big enough to be classified within industry will have SIC code. So an SIC code could be, you'll hear services and prepackaged software. In industry could be like forestry if you make like paper, it could be mining and so forth. So the combination of the SIC code plus the state of California plus the size of it here tells me that I'm probably looking at the right company. Now pick between these two, and again, you'd go through the same process if you put in another word, but if I look down here, on the top was formerly called Ozark Holding, and the one here was formerly called Oracle Systems Corp. So I feel more confident that the lower one is probably the right listing, because Ozark is probably some subsidiary or something else. For all I know, maybe it's another software company. So we go, we have the right one, and either we have all these various financial statements. Okay, now I know we actually picked the wrong one, because these stop in 2006. So the other one. Okay, so I picked wrong, but that's okay. That's what happens, right? That's why we're doing it live. So now, you have information on Oracle, and there's all kinds of information here already, right? So you can see all these different forms and when they were filed. The forms that I told you about, right? And you'll see there's so many different types of filings, right? So, we mentioned 8K, 10K, 10Q, and so forth. You'll see like there's an 8K, which is like a current report about other, we mentioned that on material events. You'll see 11K is like if employees purchase stock, but really just worry about these three for now. 10K, 10Q, 8K, right? So then, I would go to the filing type, and I can type in the filing that I'm looking for. So now, let's type in 10K. Let's press enter. So you see, 10K that was filed, going back to 2006 is here. You get further back in the past, usually more than 10 years, it can sometimes become harder to find the financial information. Sometimes it's under another subsidiary, so that's something to be aware of. But anyway, so let's dive into this. I generally prefer to go into docs rather than interactive data. There's two reasons for this. As I said in our previous session, I never say anything without hopefully having a reason for it. Reason one is this generally loads faster. Reason number two is you can see that's separated by section as the organization intended it. And three, you can always see the main body of the document by both looking at the size and seeing the type. So something that has EX next to it is kind of extra information, and the main document's here, and we can also see that it's by far the biggest in size. Let's click on this, and we open the HTML for Oracle. So this is just chock full of information. So I'm not going to go through everything because this thing's probably like 7 million pages long, but there's like some things that we're going to hit that are interesting, right? So let's take a look at this. Pursuant to the Securities Exchange Act, right? So what does this tell us? It tells us, first off, as we discussed, it's just a reminder of the fact that this has been filed with the Securities Exchange Commission. It's been reviewed. It has an auditor letter, and that's what we're looking at. We have address for the company. We have shares and where the company's traded. So we know that it's traded on the New York Stock Exchange, and it has common stock shares. And we also know the number of shares that the company has. So as of the date they filed this, you know how much the company was worth, which was $143 million, and we know how many shares of common stock they have. So they have about 4 billion shares of common stock. Well, that's interesting. And you're now down here, and this is where like the real action starts. So you see the table of contents. Generally breaks down things into 2 or 3 sections, but I will boil it down to basically 4. So here's the 4 main sections of when you look at financials, or what I try to look for. 1, I call this business and risks. I'll call management's discussion and analysis of financial condition. Some people call it management discussion or MD&A. 3 is financial statements. 4 I'll call appendix and other. Okay, let me say that one more time. Business risks, discussion or MD&A, the actual financial statements, and other, and the appendix. Now, what are these? So, in the business section, tell you all the essential information about the company. So if this is something that you know really well, maybe not so interesting, but this is a company you don't know well, this is pretty valuable information. So for example, we won't go through all of this. Oracle Corporation, provides products and services in IT. Their service involves several key layers, SaaS, PaaS, and infrastructure as a service, and so forth. Here's what our model is, and here's where our investments and other things. So in just this one little section across these 4 or 5 paragraphs, you can get a very robust, reasonable sense of what this company is and what they do. If you go on further, there will often be more detail about their businesses, what percentage contribution they had, what technologies they have, and there is just all kinds of information here. So, let this be my way of saying to you that we'll get into some quantitative stuff, and we'll keep working on this next session. But even until you manage the financial statement stuff and you feel like that's something that you can haul up and you can use as a skill, even if you just look at qualitative information here, anytime you're looking at a company and you're trying to do research or get information, challenge yourself beyond what you can find in Google to pull up their financial statement, or at the least pull up an annual report or two and read some of the stuff at the top about what the company is doing, because you might find a gold mine of stuff that you wouldn't find anywhere else. Information there is here, right? So then the company talks about their operations and all kinds of stuff. So then, the company talks about adverse risks. Now, a lot of the stuff that is here, remember how I talked about when the company goes on a roadshow and they're selling the securities for the first time? These materials, the basic statement of the company's business, their MD&A and their financials, a boiled up version of this that is usually no longer than 30 to 60 pages, this is what would be the prospectus or the offering document when the company securitizes. So the funny thing is, it's kind of like, Baby and the Grandfather. The same document that you had when you IPO'd ends up basically being the living document that is your ongoing filed financials, but just over time, more and more information, so you tack more and more on there. Sorry, 1 second. Any questions on anything so far here? All right. So, then they say who the executive directors are. We see our bud Larry Ellison here. And then, the company discloses its risk factors. So, again, I'm being a little bit cheeky here, but like someone I read this in a funny book, Monkey Business, which you should all read if you haven't, along with Liar's Poker. Michael Lewis is popular, but Monkey Business is also really funny and is about banking and DLJ. And they talk about the bank analyst who now is in like the Banking Hall of Fame because he decided there's so many risk factors, it would be better just to put 100 things in there and then no one would know which was actually a risk or not. So like everything here, from like other software companies to flood to like the world exploding, is like listed as a risk factor. So I'm being a little bit funny, but it's like literally look at these like risk factors. So it's like they start with Oracle's cloud strategy. Okay, that's probably pretty tangible. Our ability to develop new products and services. By the time you go to bottom, like seriously, there'll probably be stuff you're like, yeah, the economic, political, and market conditions. That's basically like anything that could happen on Earth ever for any reason, and so forth. So anyway, there's the list of risks. Then, the part that's often more interesting than that, though, is, let's see here, is MD&MA. So, MD&MA. Let me go back to the top here. Right. After you get through the risks, this part is often a gold mine. So in the MD&A, or the management discussions of conditions, management attempts to tell you, for actual, real, tangible things, what a business an overview is, and this is how they would like you to think of their business. In this case, you'll see or tell you about their cloud and license hardware and services businesses, each of which is a single operating segment. There's all kinds of information here about what each of them do and how each of them function. And then they often go into a lot more depth. That's the whole first section. I won't go into great depth, except that there's a lot of information, and it's a good way to get a primer on a company. Then often, before we get to the actual financial statements, there's a lot of information that gives summaries. Again, I'll go back up to the top. If you ever get lost, go back to the top and click through. There'll be a clickable table of contents. I want to go to the actual financial statement. So remember, our fourth category is like other. Now, so you've reached the actual, real, important financial statement part, because right before it, there will always be the letter from the company's auditor that indicates they've looked at the financials. So here you see Ernst & Young, and Ernst & Young has looked at and reported as an independent public accounting firm. As long as it's not Arthur Andersen and Enron, hopefully we don't have a problem, right? Now we go into our statements, and there are three financial statements, okay? So let me pull aside my funny drawings again here, and let's talk about this for a second, and then we'll come back. So, I want to take these one at a time. So there's the balance sheet, the income statement, and cash flow statement. There's a fourth, traditionally called the statement of retained earnings, but you will indulge me for reasons I promise are well-intentioned. Let's just pretend that doesn't exist for a second, because it makes things much more confusing. So, each of these three statements has a different function, and they interrelate in important ways. So, first, the balance sheet, think of it as a camera. Think of the income statement a projector. And what I mean by this is, when you look at a balance sheet, it's giving you the company's financial position at one point in time. So, in the case of an annual statement, companies have different fiscal years. The most common fiscal year, not surprisingly, is to end your year on December 31st, but there is no reason you have to do that. In fact, a common exception to this, as an example, is a lot of retailers, before Toys R Us went bankrupt. Toys R Us, I believe their financial year was January, as was many retailers, and the idea was they wanted the Christmas season to clear before they reported what their financial performance was. And other companies have various reasons for having different years. But let's assume for a second this is a normal filing for a company that has decided to end their financial year in December. Now, if that's true, the balance sheet on the 10K, or the annual report, would give you the company's financial position as of December 31st, whatever the year is. If you have the quarterly statement, the 10Q, the balance sheet would give you the statement of the company's financial position in respectively March 31st, June 30th, September 30th. The income statement and the cash flow statement are like a movie projector. They show you performance over a period of time. So, if the balance sheet is literally telling me on December 31st what do things look like financially, the income statement for the annual report will say what financial performance over the period January 1st until December 31st. If you think about it intuitively, this kind of makes sense, right? Peter would never say to you, what was our revenue on December 31st? He would say, what was our revenue for the year? Similarly, he would never say, what was our cash over the period? That doesn't even really make sense. You would want to know, what is our cash position today? Same thing for the cash flow statement. Now, On 10Qs, it gets a little bit more complicated. What they will often do is they will give you the performance over that quarter, and then they will also quote the performance over like 9 months or over 6 months. The idea being that if the statement was, let's say, in September 30th, they'll do the financial performance from June 1st into July 1st into September 30th. Often next to it, it'll say 9 months. So it'll also give you the performance from January 1st until September 30th. The idea being that in the quarterly, you can see the performance both for the most current quarter, but also year to date. Does that make sense? Yeah. So that's the general idea in terms of what the period of what they depict is. Now, if we look at the balance sheet, we'll take these a step at a time. The balance sheet is broken up into two halves. On one side of the balance sheet is assets, and on the other side is liabilities and shareholders' equity. I put a plus in there. Of course, there's not a plus on the balance sheet, but it's implied, and you can imagine it in your mind. So I'm going to put an equal sign here. The balance sheet has to balance, and that balance is assets are always equal to liability and shareholders' equity. So, what are assets and what are the categories in there? Hold with me on that for a second, and we'll do it. But just know this. When we talk about assets and liabilities, and that is believed to have a lifetime of a year or less is considered a current asset or a current liability. Put that here. Anything that is expected to have a longer term life is just called long-term. Now, we'll go through what those line items are, but that's the balance sheet. And another important thing to remember is the balance sheet is also generally organized from top to bottom on the asset and liability side, from the shortest term assets and liabilities at the top and the longest term being at the bottom. Another way of thinking about their lifetime might be the word liquidity. So the most liquid assets and liabilities, meaning the ease at which you can convert them into cash, are at the top and going down. Now, the most liquid asset is cash. So the first item on any balance sheet anywhere in the history of finance is always cash. I mentioned that, I said I wouldn't get into the details, but I will mention cash because the financial statements interrelate with one another. And here is how they interrelate. Cash is the first item on the balance sheet. The cash flow statement is broken up into three categories. And again, I'll explain what these are. But there's operating, investing, and financing. When you add those three together, those become your net cash flow. And you take your cash from last year, add your net cash flow, and that equals your new cash balance. I will review the cash flow in a second, but here's where it gets interesting. The ending cash balance that you have on the cash flow statement has to match, I'm drawing an arrow here, it matches the cash balance on the balance sheet. So that's how the cash flow statement and balance sheet interrelate with one another. In terms of each of these three categories, there are different things with each one. The operating cash flow can be a little bit more complicated, but it is supposed to represent the cash flow from your normal business operations, top of which is your net income. So the operating portion of cash flow is net income minus the technical term of a whole bunch of stuff we review. Is operating cash flow. People often confuse investing and financing cash flow, and they're like, aren't those the same thing? So I'll explain it to you in a way that'll make it hopefully easier to remember. When you think of investing in the context of financial statements, I think of capital investing. And when we say capital investing, we mean the purchase of property, plant, and equipment that is capitalizable. Capitalization is a determination made between legal accounting about whether a purchase you made represents an asset that has a useful life that can be depreciated. So if I purchase a sandwich doesn't have a useful life. It's something that you eat and it's done with. If I purchase a table is a durable product that has some lifetime and a depreciation window. So I have a whole discussion about depreciation. But when we talk about investing, what we really mean is invest P&E, so close to our hearts. It could also mean things that have an intangible long-term value, right? So things like software. It could mean things like patents. It could mean things like forms within medicine. If you have a physical asset, depreciated, we call that depreciation, obviously. If you have an intangible asset, we call that amortization. So depreciation and amortization.
I understand like the purpose of you want organization, but other than that, is there a purpose to why we separate it into three functions?
That's a good question. That's a great question. So the reason why is each is a different picture to a different aspect of decision making. The operations basically tells us. Here's the way of thinking about it. Think about kind of like mandatory and discretion, right? So the idea, obviously, of control over the income too, but the idea is to operate our business this way, as reflected in the income statement, its cash impact on the business is all going to be represented in that operating slice. The investing slice is going to be, how much did we decide to invest in equipment and capitalized whatever, and why? Financing one is also discretionary. So that is share bond issues, mostly. On the outside, share bond repayment and dividends. At least that's the classic way of thinking about it. So, if we issue shares, and we issue shares at $100 million, the cash balance would show up on the balance sheet, but cash impact would be shown here in the financing, in the cash flow statement. Same with bonds, we pay them down. Obviously, if we payments, that would be a cash outflow, and then add all three together. The part, well, actually, let me pause there. Any other questions on the beat of the cash flow statement for now? Okay. Statement. I'm going to take this in reverse to show you how they articulate. I mean, it's really pretty neat. So the statement, and it's a very tippy top, although a lot of companies don't externally report bookings, starts with bookings. Some companies do bookings and billings. If they don't, then it's a whole bunch of things related to margins of various type, and you're going to have some combination of expenses of various sorts. You're going to have margins of various sorts, and then get through it all at the income statement, or your income statement, you have net income. Somewhere in between there, you have operating income, and gross margin and so forth, but we'll go through what all of that is. When you have net income, and the final calculation that is made is you usually have the number of shares, basic and diluted. I'll explain what that is in a second. You divide net income through shares, and you get EPS, or the earnings per share. The other way that the financial statements interrelate is, which is the final item on the income statement, right, is the item in the operating cash flow. Neat is, again, balance liabilities and equity. The cash flow statement connects to the balance sheet. The income statement connects to the cash flow statement. So really cool is every part of your operation is like this well-oiled and functional machine where, you know, squeezing one part of it shows up as impact somewhere else. In terms of basic and diluted shares, is that goes up to more complex hybrid and derivative and convertible securities. So for example, I've heard of convertible debt. Sometimes companies will issue convertible debt or they'll issue stock options. Those are fixed in some securities, which at some price level convert into stock. The idea with basic stock is that's what we have right now. All the hybrid shares that we have available will convert to stock. How many shares would that be? And diluted is almost always the better way to look at a company's shares because it's the total exposure of what the shares could be. This is less of a concern as companies have moved away from stock options, but you know, when I was in high school, less expensive than it is now. And also, the diluted shares were a much bigger issue because a lot more companies stock options. And so the issue of diluted shares was a really big issue because if you were Pets.com, besides your like sock puppet, you know, your assets were often issuing shares left and right to people. So anyway, the income statement, the balance sheet, and the cash flow statement at the 30,000-foot view. Any question about that? Okay, now we'll actually look at these. So, NEAT has a lot of leeway from the SEC of how they can report their financials. But find various trends over and over again that allow us to generalize what is in there. So, generalization is, let's sit here. One second, look at my phone. Okay, so I'll give Luke 1 second. I don't want him to miss this. I'm no stranger to love. Call the way for something. I will start slowly on this. So, the few general things we can find here, right? So remember what we said about current assets and current liabilities. So we'll keep going one level down at a time, like one of those Petrushka dolls, right? So if you look at the overall balance sheet, let's note first what we see here on the top and the bottom. Oh, there's my man. All right, so if we look at this, you'll see first, Oracle, in fact, has a non-standard year. So remember how we were saying some companies don't end in December? They, in fact, don't. So their balance sheet is as of May. So the first thing you'll see is some companies give you 3 years, some even give you 5, but 2 is common as well. So you'll see that they've given us their balance sheet position this year when this was filed, which was 2018, and for last year. This is actually relatively fresh off the presses. So this is a point-in-time measure. As we mentioned, just like we outlined on our little page, you'll see that there's assets on one side in bold print. That adds up to 137,264. And similarly, there's equity on the other side, which also adds to 137,264. You'll see that the assets is broken down between current assets here, which is 75964. I'm referring to 18 numbers here. Non-current assets or long-term assets, which is 613. You'll also see down here the total current liabilities and total non-current liabilities. And then this bottom section is equity. So now, let's go through.
I have a question real quick.
Yeah.
So this is, the numbers are in millions, I think. Do they report like the exact up to the cent, or do they report in millions?
So they do report the exact dollars to their accountants and to their auditors.
Okay.
And their accountants and auditors hold it, but in terms of what's filed, they only go to a degree specificity that is deemed reasonable for their size of operation.
Okay.
Good question. So, as I said, a lot of these vary, but here's the general rule you're going to see. In current assets, you're going to always see cash. So the first 2 line items will generally be cash only, or cash and some form of marketable securities, just the word securities, but they basically mean the same thing. So these 2 things are, what does the company have that they can immediately turn into cash? Cash generally is in cash form immediately, or cash equivalents. Marketable securities are those which could be quickly converted into cash. So if I eyeball this basically tells me that the company could convert, they have $22 billion in cash, and they have $46 billion more in cash they could have access to very quickly if need be. Trade receivables are $5.3 billion. So again, classic accounts all companies will have. They'll have something that either says account receivables or trade receivables. What account receivables mean is these sales that have been made to customers, but the company has not collected yet in cash. You'll see that it says in parentheses, net allowance of doubtful accounts. So what that means is, it says, what is it, 370? Humor me, and let's imagine that number was just 400. What that's saying is, the actual number was 5679, but the company expects that they've made an accounting application that $400 million of their sales will not be collected, either because people will cancel sales, renege, or default. That's account and trade receivables. And then finally, this is again a classic one, prepaid expenses and other current assets. What this means is the company is prepaid something. So like a funny example, let's say Oracle has prepaid cleaning service to clean their building. They've paid them $100 million for all their building maintenance and all their putting tables back in, fixing the walls, construction, everything. They paid that to their contractor. The contractor has not delivered on their work yet. That's a prepaid expense because the company has prepaid the amount of money for an expense that it can expense and take advantage of in the future, but is not yet. That's why it's an asset. So, some current assets on a balance sheet will go 15 line items long. Some will go 4, but that's basically, you actually picked a very good one here in Oracle because that's basically the structure that matters. Cash, some form of cash equivalency, account or trade receivables, prepaid expenses, and then sometimes there will be some other little small things. We sum those all up, we get our total current assets. So that's what current assets are. Any questions? Okay. Next, we go to our non-current assets. So this is a little trickier, but we'll go through it. First, we have property, plant, and equipment. So here's how property, plant, and equipment works. And this interrelates a bit with the cash flow statement. So I'm going to pull out, oops, not Word. Property, plant, and equipment works is you have a starting balance of property, plant, and equipment. So let's take a simple example. Let's say your property, plant, and equipment of all your machines, your factories, your buildings, cars the company owns, tables, is 1,000. If the company spends more money on capitalizable assets, so let's say we buy 1,000 more servers for 300. Let's assume 100% of that is capitalizable. Sometimes not all of your expending on such assets is capitalizable, but let's assume it is. The $300 gets added to your original balance for property, plant, and equipment. So you had 1,000. You add 300, now 1,300. You take off of that the amount of your assets that you depreciated. Now the decision as to what you depreciate and how is a very complicated one, but I'll briefly explain this. There's basically straight line and other options. So straight line would be, let's say you bought 1,000 in equipment, and then it's, let's say, tables. The accountant, along with your auditor, will work together and make a determination of what the useful life is of that asset. Things like durable equipment, property, plant, and equipment, they only have a useful life of 5 to 10 years. Longer life things like, again, I keep going back to furniture because it's right in front of me, but furniture and stuff like that, much longer life for buildings, 20 to 40 years. But let's say for sake of argument, you bought something for 1,000 and the accounting determination is the useful life is 10 years. You would expense that at a value of 100 a year, and you would basically take the depreciation value off of the PP&E. There are other accounting options that you can do, some of which have funny names like double declining appreciation or accelerated cost depreciation. The simple idea being that there are other accounting and financial treatments where if you want to depreciate the value of an asset faster, you can. You may ask, why would someone want to do that? Well, sometimes people may want to take the hit to reduce their net income to pay less taxes. So the reason you do that is basically for tax planning reasons. But that's how property, plant, and equipment works. You have a property, plant, and equipment balance. You spend more on capital expenditures, it goes up. You depreciate it, it goes down. That's how you reach your ending PP&E balance. Typical in the way financial statements are reported, what you see on the balance sheet is a net PP&E number. So someone's already basically calculated for you this number on the bottom. And if you want the detail about how they did this whole thing, it's usually in that other category that we talked about in the footnotes, where they'll go into great detail about like how much was spent on capital expenditure and what the useful life is and how they calculated it and so forth. Any questions on that? Okay. So, an equipment, and you'll see that here it says net. So again, that is net of all the calculations. So they've taken into account the capital expenditures and the depreciation. Intangible assets is the exact same thing, but it's just for the intangible side. Right? So property, plant, and equipment would be we bought a machine, it had a certain value, we added to it with CapEx, we depreciated what we had left, that's the net PP&E. Tangible assets is, again, things like patents, things like, drugs, things like software that's been developed. You would follow the same formula. You would have a starting balance of intangible assets. You would spend in capital expenditures to raise it up. The only difference being that instead of depreciation, you call it amortization, and you reduce value to get the intangible assets. So again, those are two classic line items that you would find on most financial statements. I go out of order and refer to the deferred tax assets and other non-current assets. So this is a similar idea to what I explained to you about the prepaid expenses, right? So in the prepaid expenses, you paid for something, but you haven't taken advantage of it yet. The only difference between that and things like deferred tax and other non-current assets is these are things that, remember, have a lifetime of more than a year. So let's say the companies that have financial losses are allowed to carry back and forward with certain rules around it, their tax losses to use against future losses. So if you lose $100 million this year, and then next year you have $200 million in profit, with some exceptions, the government will generally allow you to take that $100 million loss and carry it forward. So instead of paying taxes on $200 million, you only pay taxes on $100. That would be a deferred tax asset. Similarly, there might be other non-current assets that you're owed by other people that you can deploy as expenses. Those would fall into other non-current assets. Okay? Then the plug is goodwill. So goodwill is the explanation for everything else that you have in terms of assets that can't be plotted to something else. So we'll go through liabilities and equity in a moment. But the idea is, let me give a very extreme example. Let's say we started a corporation together and we went to the market and we raised money. So let's say we went to equity markets and we issued stock, and the only thing we had on the liabilities and equity side of our balance sheet was $1,000. Let's say we added up everything else on the balance sheet, got to $800. We know the company's valued at $1,000 because that's what it's worth. Like, one of the nice things about financial theory is, for good and for bad, something is worth what someone's willing to pay for it. So if someone put $1,000 in for the equity, the company's worth $1,000, by gosh, right? So, if everything else adds to 800, and we know it has to add up to 1,000, the remainder of that value has to be ascribed to something. And so what happens is we ascribe it to goodwill. And what that's basically saying is, well, this company's worth $1,000. We only have $800 in other material assets, so the rest of the representation must be some goodwill assessment on behalf of the investor that they are vouching for the worth of this company beyond book assets with its goodwill value. That's why, and again, I'm getting a little bit more complicated, but you guys can handle it. That's why when you do mergers and acquisitions math, in addition to other things that you amortize, and again, to a lot of technicalities, one of the rules years was to basically revalue goodwill. So like if I bought your company and your company was worth $5,000 in book assets, bought it for $10,000, what would traditionally happen is, another way goodwill can be created is, if we're $5,000 and bought the company for $10,000, I would take all that extra $5,000 that I paid over your asset value and I would put it in goodwill. The asset value has no financial representation. I've created value by overpaying. Make sense? Okay. Takes us through the entire asset side of the balance sheet. Now we'll go through liabilities and equity. So liabilities and equity, again, a lot of these are concept of a general structure that you see over and over again, and what makes this nice is these are just counterpoints to stuff we see on the other side of the balance sheet. So in the set of cash, and cash is a current asset, notes payable and other borrowings are a current liability. So notes payable and other borrowings are not like bonds and stuff like that. That goes in long-term liabilities. But if I, have it line with the bank and borrowed $1 billion from the bank, that's all in note payable. If accounts receivable is, I've made sales to other people, but they haven't paid me yet. Accounts payable is, someone else did something for me, and I haven't paid them yet. This is payable. Accrued compensation and related benefits is, let's say we all work at Veeam, need certain health benefits that are stipulated in our health insurance. We all have health insurance with the company. We all signed up for the plan and we're paying in benefits. All benefits that we're owed for our current insured period are accruing and are going to be paid to us when we're owed them. The accrued compensation related benefits show up here. Deferred is we've revenue but actually delivered the work yet against the project. That's deferred revenue. And then some other things are fill, which are other current liabilities. So again, there are variations sometimes in other line items, but canonical things you'll see is you generally will see notes payable or borrowings or something like that, accounts payable, some about accrued or employee benefits, and deferred revenue with some type of other line, sometimes with more detail. So that's total current liability. Liabilities, so we have payable and other borrowings. So this would be all borrowings and debt and bonds that we have that has a lifetime of longer than a year. All bonds and debt that we owe. Is we book taxes, but we haven't paid them yet. That's pretty simple. And then other non-current liabilities. So again, pretty straightforward. Again, is canonical stuff, total liabilities, total non-current liabilities. So we're almost done, guys. So all that's left now is, what in the world is this? You know what, Google, you need to relax. Okay. The final section we have left is equity. So it's a little bit tricky, but we'll go through it piece by piece. So when about equity of a company and how you represent it on a balance sheet, this goes back to very old definitions of equity issuance going all the way back to the start of the century. So it used to be that you issue equity shares. Equities used to be physical instruments, right? So maybe you guys were kids, you get a grandparent or something like that, you'd get like a savings bond, or you'd get maybe like a share of Disney stock, and someone would give you the physical certificate. The idea was, physical certificate had a par value. The value is 99.99% of the time, the par value was a penny. And all that means is, a value not being a penny only comes up in very edge case financial stuff, which is way beyond anything we should be talking about today. But the idea is, it's just basically signifying that that piece of paper that represents the stock or the entity of the stock has some non-zero value that basically marks its existence. So what you can see on the balance sheet is they'll have part, which is a penny, and then have what's called additional capital, or it's abbreviated as APIC. What that means is, you see that here, it says shares, then 4,100. What basically saying is all the share issuances that they're putting up to get the company's common stock value. One thing that is very important to note here is this is not the equivalent of the company's market value in the stock market. Those are completely different. This is a book valuation of the stock shares when they were issued by the broker-dealer. Okay. But retained earnings. What retained earnings is every year of the company's operation, you or net loss. What that is goes to retained earnings. So the idea is the equity that you built up as a company is a combination of the valuation that you had when you securitized and the income you generated over time. So you securitized with an equity value of $10,000 and you generated net income of $1,000 for 5 years in a row. Your retained earnings are $5,000, and thus your total accumulated equity is $15,000. There's accumulated other comprehensive loss. What this means is kind of take every other controlling interest that Oracle has that may have had a loss of some sort, and they've aggregated it together. But the way I think of it is the returnings and the accumulated other comprehensive loss kind of offset each other. So basically what you have is you have equity and you have all the incomes and losses that have been generated over the lifetime of the company. You add those together, you get stockholders' equity, and sometimes below that, as is true here with Oracle, if you have a larger company, they will have what are called non-controlling interests. So Oracle, like many other large technology firms, makes other companies. So in order to get the total equity, they will take the stockholders' equity that is all based upon Oracle's direct controlled interest, and they add the non-controlling interest that Oracle has in other entities. That equals the total equity. You have total equity to total liabilities, you get total liabilities of equity, and that matches the questions? Good? Feeling easy? All right. God, I love these service emails I get from people. Okay. So, to hit the income statement. What is sometimes colloquially known, the consolidated statement of operations. So, now, remember, we're using from a time for both consolidated statement of operations and the cash flow statement were over a period of time. You'll see that in the case of each of these, rather than saying just time, May 31st, it ended. So it's over the entire period. So each of these represents a year of operating results for each respective year. The good is, the income statement, I think, is a lot easier to explain than the balance sheet. So basically, you'll see here, Oracle to not report their bookings to their billings. So we're starting at revenue. Revenue is broken down by operating division for Oracle. So you'll see that it seems like they've broken it down into 4 operating divisions. Again, something that should kind of ding in your head whenever you see something like this is there must be a lot more detail on this in the footnotes. So it's in the income statement, there's a lot more detail. In fact, for specific things, they'll even put like a one or a footnote on it themselves, but like you can feel fairly confident that if it exists as a line item here, there's something somewhere in the appendix of the footnotes. I would argue that if you look at the annual report, the further you go through it, the more valuable things get. So like on the front, complete marketing, nice stuff, but not very financially valuable. You get to the note from management and the business overview that we did first, it's kind of interesting, but it's kind of qualitative. You get to the financials, you're like, oh, this is interesting. Now I actually have the numbers and understand how the business works. But then you hit the real gold in the back, which is in the footnotes, where like if you're really doing your analysis, like the kind of skeletons in the closet are hidden and you can get the real insights. So anyway, we have the revenues here, and the revenues are broken down by operating segment. Following that, we have the operating expenses for the firm. Now I should note one important point here, which is Oracle, like many software companies, does not have gross income. If this was TJ Maxx or Whole Foods, you expect before we get to the operating expenses, let me get out my little paint here. If this was, come on, switch over, there we go. So if this was TJ Maxx or Whole Foods, you would expect revenue, cost of goods sold, or COGS, gross profit. Now what does that mean? In companies differentiate between direct and indirect expenses. For software, there really isn't a direct expense. But if you think about, something like clothing or food, the indirect expense would be, in the case of clothing, the direct cost of the clothing itself, and on the food side, the direct cost of the food. I should note that I didn't mention this, forgive me, on the balance sheet side, but I will now. Another thing that we didn't see, because this is a technology company, is inventory. So for companies that have sales, like Whole Foods and TJX and so forth, you expect in the current assets to also have inventory, which is broken down between raw materials, in-progress goods, and finished goods. To basically say, companies that carry inventory give you a lot of detail about how their inventory breaks down between, let's take TJX again, by Oddworks there, sorry, I'm partial to it. But it's like, raw materials, is it literally like cotton and polyester? Is it in progress goods, like it's in the factory and being made into clothes? Or is it finished goods, like we have the t-shirts and they're like on the rack, right? So as you go through the chain of production, obviously the inventory becomes more valuable. Ironically, in many cases, its resale value can be a lot less. Because you have bales and bales of cotton, their value is low, but cotton can be sold to anybody, versus if you have a bunch of shirts that say death metal glam on the front, there may not be many people who actually want them anymore, okay? So anyway, understand this idea of cost of goods sold, and the idea that in companies that have direct expenses, they'll take their revenue, subtract the cost of goods sold, which is their direct expense, and they will sum that together, revenue less cost of goods sold, to calculate their gross profit. The gross profit divided by the revenue is, of course, the gross profit margin. Sometimes companies also that are very sales heavy, like TJX, will say that their revenue is net of doubtful accounts. So for example, retail companies in clothing will often make an allowance of anywhere up to 1.5%, something like that, for basically sales that won't go through, maybe because people use bad credit cards or their checks bounce or something like that. So you can always assume the revenue is net, but it's another place to check for doubtful accounts. So anyway, here we don't have any direct expenses or gross profit because it's a software company. So we have revenue, and we go directly to operating expenses. So here, there's some things here that are classic, and some things that are a little bit more unconventional, and I'll explain both to you. So here, let me see what the footnote says. Okay, so here, Oracle has chosen to break down their cloud service, hardware, and services related expenditures of running their business. This is a little bit unconventional, and maybe is just an oddity of how they've broken down their categories. The more traditional ones appear for almost any company are sales and marketing, which is attributable sales and marketing expense, pretty straightforward. Research and development, G&A, so us, corporate people, legal, that type of stuff. Amortization of intangible assets. Some companies will also break out depreciation here, but in this case they've chosen not to. Acquisition-related and other expenses, so, what were the costs of them doing deals? I'm guessing this would probably be fees, like legal and banking fees, but it could be other stuff, or write-downs or something like that. And restructuring expenses, again, maybe write-downs or other expenses related to either shutting down or reorganizing major parts of their business. If you add all the operating expenses together, you get the total operating expenses. Again, if we had gross profit, so if this was a retail or not a tech company, we would have had revenue less costs, which would have been gross profit. We would have taken gross profit less operating expenses to get operating income. In this case, we don't have direct expenses, so it's revenues, the total operating expenses, that gets us to operating income. This is also in many cases known as EBIT, or earnings before interest and taxes. The reason that's differentiated from non-operating income or net income is there are other adjustments that can be made to a company's income profile to go from operating income to net income, which are not related to operations. So in this case, two classic ones are, depends where they put taxes. In this case, they put just interest. So the two classic things that you adjust for from operating income to net income are interest and taxes. In this case, they take an interest expense, so operating income less interest expense, and then you'll see that they've subtracted through to get non-operating income, which in this case is 12. Oh, I can't read the blue and white lines here. Non-operating income, right, is 1237. So, oh, sorry, I see what they've done here. So they've broken out, forgive me, they've taken operating income, they've taken interest expense, and then they've recorded non-operating income. So non-operating income could be stuff like having like a one-time gain or loss on business. So let's say you sold one of your divisions of your company to somebody else. You would make income, but first of all, for a private equity firm, buying and selling businesses is not part of your core operations, and it's a one-time thing. So they've recorded that here. They have the interest expense and their non-operating income. If you take operating income, you add the interest expense, and you add that one-time non-operating income, that sums to the income before provision for income taxes. Next, you take out income taxes, and that gives you your net income. Finally, down here, remember what we talked about with basic and diluted shares? You'll see they're both listed here. And if you divide the net income by the basic shares, you get 93 cents. If you divide by diluted shares, which is going to be a larger number, the diluted earnings per share is always going to be lower because the diluted shares will be a higher number, right? All right? So that's the whole walkthrough of operating income. I should make one other note, which is two more little notes. One is at the bottom. You'll see that companies will often list how much dividend they pay per share. That can be an interesting way of knowing how much money is going back out of the company due to discretionary reasons. And the second one is people will often adjust the operating income. So operating income is one of the most popular financial metrics for company performance for a reason. It reflects not just top line, but reflects the company's total operating performance that is regular and recurring. The second point, though, is some people will adjust that even further. So you may have heard of a metric called EBITDA or EBITDA. EBITDA is you take the operating income or EBIT and you add back the depreciation and amortization. The reason some people do that is the idea is depreciation and amortization was an investment decision that you made. The same way that you don't look at net income commonly because the operating income is recurring and operational and things like interest and net income aren't part of your normal operations. The idea with EBITDA is adding back the depreciation and amortization. If you have one company that made no investments at all, and you have another company that invested very heavily in their business, by adding back the depreciation and amortization, you are not penalizing the company that invested heavily in their business. In other businesses, other things might get added back. So like EBITDA is by far the most common for companies that are very big retail renters that have a lot of leases. There's also EBITDAR, which is they add back rents. So you're not penalized for buying versus renting because, again, unless you're in real estate, that's not your business. I've also looked at some funny ones. EBITDA, adding back depletion for companies that work in like mining. So anyway, there are a lot of metrics that are industry specific. So anyway, that's the income statement. Any questions on that? Awesome. All right, so let's go to the cash flow statement. Again, this is retained earnings or comprehensive income. I'm not going to talk much about this except to say that you wonder sometimes what comprehensive income is. The company will break it out for you. So you can see what were the other things that caused them to gain or lose income that weren't operation-based. Some of that was because of foreign currency changes, some was because of the benefit plan, some of it was gains or losses of marketable securities. So again, kind of interesting, but beyond the scope of what we're covering today. And then statement of return to equity, which we're not really going to talk about. I'll tell you what it is, which is what this tries to do is it tries to give you a much more detailed reconciliation of what happened to equity positions in the company. So basically, if you're interested in how and to what magnitude has the company compensated people with stock, bought shares back, issued stock, made distributions, and so forth, that level of detail is presented in excruciating detail here. But it's a pretty specific thing. I can honestly say, other than being aware of it as an accounting concept, I probably have used this once in my entire career. So it's like, it's really not interesting. But yeah. Okay, so now in the cash flow section. So you'll let me make some of these windows here. Hardly. Close. Sorry. Just keep going. Okay, so 3 years of data here. Each one represents a year-long period. And as we discussed in our little cheat sheet before we went in here in Microsoft Paint, right? What did we say would be here? We said it would be net income, operating cash flow, investing cash flow, financing cash flow. We add the four of them together in order to determine the effect on cash. So like we said, you'll see net income at the top. Then this whole section here is the cash flow from operating activities. So, very specific, but remember it as this if you can. Basically, the things always going to be there is depreciation and amortization, helpful accounts for receivables, usually some other stuff, and the big section here, which is change in operating assets and liabilities. So the explanation for this is basically, as your operating balance sheet line items change, they generate cash. So, for example, if your accounts receivable, remember that's if you're owed money that you haven't been paid yet, if accounts receivable goes down, you expect that your cash should go up because you made money and that accounts receivable went down. So basically all the changes in the balance sheet items are offset here by cash flow changes. So that's the operating cash flow. In cash flow, you'll see is actions, FX. In this case, they put the purchase of marketable securities in the middle. Sometimes that is represented in financing activities, but they've listed it here. But as we said, the one thing that is in investing activities to remember is capital expenditures. Although, again, in this case, the largest number is marketable securities because they put it there, but again, I would put that in financing activities, but you can do it either way. And in the activities, as we said, and payment, purchase and issue of stock and debt and that type of stuff. Together you have your cash flow, your investing cash flow, your financing cash flow, and then there's sometimes when we some other small adjustments like a classic one is the effective exchange rates on cash. You tax that you started with, you add cash change, and you get the ending cash balance that matches 21,620, 21,620 on the balance sheet up here. Similarly, as we mentioned, then 3825 matches the. So that's how three financial statements, again there are four, but no one uses the fourth. These are the way company's three financial statements work, what they mean, and what they are. And on that.
A lot.
Yeah. Yeah. So, and like I said, for you guys are great for 20 minutes, like this part, I mean, some people will spend a lifetime, right, in academia studying financials and what they mean and so forth, but I can honestly tell you, like, even if you study finance in college for like 4 years, you're basically taking this and just break it down into finer and finer and finer chunks of like what each piece means, right? Finally, real gold is in the back, right? So now, this is the most exciting part of financial, the notes. So notes gives you all kinds of valuable information. So, stuff on their accounting information, which usually isn't very interesting. But what starts is each of the notes. So, down, they talk about stuff like revenue recognition. Putting stuff in here. They'll tell out their marketable securities. Like with actual real stuff. They got what like their research and software costs are, their acquisition costs. On their cash and how it breaks down by type, right? They tell you the maturity and the debt that they're paying on their debt. That's very good information. They got PP&E. They have PP&E listed in here. They tell you what the estimated useful life is. They tell you what the value is. So you get their plant and equipment plus the accumulated depreciation to get the net amount. Their their intangible assets, so how much did they capitalize in terms of technology, support agreements, and stuff like that. I mean, this is really good stuff, right? Then they go in excruciating detail on all their notes, so you can understand exactly what the debt and percentages are and everything. Their credit, their restructuring, right? Remember, that was a pretty big expense. This is what the restructuring plan was. It looks like they had a big restructuring in 17, 15. What that looks like. What their deferred revenue consists of. Then derivatives, so like all the hedging and currency swaps they have. Derivatives on their books, which are pretty small. The leases that they have for furniture and equipment. They told there's equity. This is a sleepy one that a lot of people think is not worth much, but employee benefit plans is awfully important. I'll give you a big example. When the auto industry started to collapse, a lot of people didn't realize that one of the big reasons, and some of the smarter analysts who uncovered this early, realized the company had funded pension obligations to the auto workers, up to tens and hundreds of billions of dollars. But the information was all right there, you know. In fact, they'll often tell you for their open obligations, they'll tell you like for every percentage of health costs go up, this is how much our pension obligations will increase. For every percentage interest goes up, this is how much our pension obligations will increase. And that's their poster plans. And anyway, you get the feel for, and there's often a lot of detail on taxes. So you see here, you can understand what the tricks they're pulling with taxes. So they'll break down their taxes in great levels of detail, federal, state, foreign. They'll tell you what their statutory tax rate is, what they're actually paying, and how they're getting around paying taxes somehow. Everyone signs in and has a party at the end. So, you know, there's a lot of information back there. So you add it all together, that's pretty good stuff. Okay. Any final questions on financial statements? Cool. So now, and going to the next section if we need to. Now, and this has to go, I think, in this order. Now we're going to talk about ratio and financial statement analysis, okay? Let me tee this up for you. And we've gone really long, so I'll tell you, we'll go 10 or 15 more minutes, and we can probably stop there. But I want to make sure that I kind of whet people's appetite for next time. This material, so I'll find something better on this, but again, not to repeat myself, but when I was like, you know, I want us to look this up together and not have a pre-formatted sheet, right? Now, any of this, or you're like, oh, what was that one term you said, what's deferred revenue, what's whatever. The structure, the very general structure at least, sits in your mind hopefully, and you remember SEC.gov, where to find the financials, the general stuff, and now if you just literally type in financial statements, or what is a balance sheet, or what is the income statement, right, you can refresh yourself in a second. For this one, if you type in what are financial ratios or financial ratio analysis, a nice site is Investopedia, for example, and you'll hear there are so many different ratios, and we'll go into this in a lot more detail next time, but once you have of knowing what the financial statements are, you start running various ratios that you can use for comparability between companies to see how they're performing. So let's take a few of these to get you a little bit excited about this. Next time we'll talk about these in categories and why they're important. So for example, I did this by putting in ratio analysis, and this first link came up on Investopedia. There are 100 links on stuff like this. So, ratio, one example. The ratio is a liquidity ratio. What that basically means is, and they've written it here, but I'll just put it in my own words, you basically want to know how solvent the company is in terms of current assets versus current liabilities, with the idea being your long-term liabilities are more than a year out, so it's not likely you're going to have to repay them immediately. But current liabilities are within a year, so you'll have to be able to make good for those liabilities within a year. Similarly, your long-term assets are not immediately liquid, so it's not likely you're going to be able to turn them into cash immediately. So the idea is, if you were to come due on all your liabilities, or the way I think about it, if you were to come due on all your current liabilities tomorrow, could you basically cover it with current assets? Or have a good representation of current assets to current liabilities? And so that's exactly what it is. The point is current assets divided by current liabilities. And you know that current assets and liabilities are on the very good. Now you go to the balance sheet, you just take those two numbers, you divide it by one another, and you have the ratio. You know, a good general rule of thumb without specifics to any industry is a ratio over 1 is good because you have at least more coverage for your liabilities than in your assets. In some industries, the ratios can be higher than that, and some may be lower in industries that are like very capital intensive and stuff like that. So, yep, they say the same thing, I agree. A ratio of 1 or greater is an indication the company's well positioned. Yep, very cool. And of course, you know, as with any of these ratios, none of the whole story, you know, you need a lot of them in concert with one another. The opinion on the current ratio is the quick ratio. So the quick ratio is, remember we looked at the various categories in current assets, and you might remember some of the classical ones that we reviewed together were cash and equivalents, marketable securities, which were cash-like instruments that we can convert to cash quickly, and accounts receivable, which is sales made but we haven't been paid yet. The current ratio is current assets over current liabilities. The quick ratio only takes 3 of the line items within current assets, which is cash, marketable securities, and accounts receivable. The reason it's called the quick ratio is, while all the current assets are technically convertible to cash within a 1-year time frame, these are the 3 that you probably could convert to cash the most quickly. So the idea is that if you really were strapped for cash and you needed money to cover current liabilities, this is like the most competitive ratio. So, you know, if the current ratio is 1, maybe your quick ratio would be 0.5 or something like that. So if your quick ratio is 1 or more, well, that's really good because you're solvent even on just your equivalents, securities, and accounts receivable.
Do you take your, I'm drawing a blank on the account, but the like bad debts expense out of the accounts receivable or allowance for doubtful?
Yes, very good. So definitely. So an important point to bring out there is, that anytime we talk about like gross versus net balances. So let's take the example Alice has given of accounts receivable, gross, bad debt, net accounts receivable. You can always assume that people are talking about net.
Okay.
Always net.
Okay.
So let's take, you know what, I will end this even a little earlier. Let's take one more. This is not a liquidity ratio. Let's do return on assets. That's it. So return on assets is net income over average total assets over a period, right? So in this case, what we would do is, here's how you would look it up on the financial statements and what it is. You would go to the income statement, you would take the net income, let's say it's for 2018, you would take December 31st, 2017, let's say, for the year. You would take that net income, you would take the average total assets, which in this case would be easy, because you know, you would go to December 31st and take the total assets at the end of 17. You take the total assets in 16, add them together, divide by 2. The idea of this is, what's your asset efficiency? So if you have 100 in assets and you generated 10 in income, and you had 100 in assets and you generated 20 in income, you are much more asset efficient than I am because you're able to generate more income out of lower capitalization. Right? That ratio. What jumped into my mind there? I was going to say, oh yeah, so I did not hit. So, I have questions for you, but I didn't have even answer yet. We need to talk about ratio analysis a bit more. So should you use debt or should you use equity, right? This has been a question that's been discussed for, decades. In fact, a gentleman named Roberto Modigliani, won the Nobel Prize for work he did on trying to understand debt versus equity, amongst many, 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 many people. But the idea is, like relationships, it's complicated, right? So the idea is, there is no simple answer, and there never will be, but these ratios, combined with your understanding of financial statements, will start to make you think about what are the trade-offs of what I'm doing. So for example, let's take an example here, return on assets, right? Let's say I was thinking about issuing debt versus issuing equity. A trade-off might be, if I wanted to raise 1,000 and I issued 1,000 with debt, I have to pay interest on that debt. The interest I pay on that debt hits net income. So if I issue debt, my net income would be lower. So as a result, issuing debt versus equity would make me have a lower return on assets. On the other hand, if I issue equity, I am giving up ownership in my organization and reducing my own personal stake. So again, it's not all numbers. Part of it is also some type of a calculation. In many senses, frankly, even if it shouldn't be, in economic senses, it shouldn't be an emotional decision. For some people, it's an emotional decision, understandably, of whether they want to give up pieces of the company in addition to the numbers. So that's one very simple example of how you start thinking about debt versus equity and the pros versus cons and how it shows up in the ratio. So, thank you, gentlemen. Thank you on the phone to Matt and James. I hope you enjoyed it, guys.
Very much so.
I'm so pleased. And to anyone who watches this recording, I appreciate it too. I'm very, very appreciative to Luke for helping Alex get these together, appreciative to Luke for chopping up the videos, and he's started a really nice effort to post these onto YouTube, which is absolutely fabulous. And, if it's not too much trouble, Luke, I'd be very grateful for this one, too. Very, very grateful for that. And next time, we're going to hit hot ratios, talk a little bit more about what they mean and how they characterize. And the next question is, if first we built up what organizations are in finance, then we understood what they do and how they capture their performance and statements. And then we talk about the ratios and how we analyze that performance. The final sense is going to be, how do we take all that information and actually break it down into evaluation? So if I know all the stuff that we just said, how do I know that, Oracle is worth $40 a share, and if it's trading at 50, it's undervalued or it's overvalued? So depending upon time, we'll do that. And I'm trying to remember. I know you're working through, find me out, I'm sorry, I forgot. Is this your last week?
Yeah, this is my last week. Yep.
Let me ask you this.
Yeah.
I'm sure Beth wouldn't mind. If we ended up doing more sessions, would you like to dial in?
100%, yeah.
Okay, so let's all stay in touch. And, my hope is, let's do this. Let's do the next session. I don't want to rush it, and I want to do this at a reasonable pace. And then, depending upon interest and stuff like that,
keep pushing.
Keep pushing forward. I want to let this stuff kind of gestate and see what people think who maybe watch some of the content online. You can let me know if you get any feedback back, and we'll keep it going, okay?
Totally agree. Thank you so much.
Thank you, everybody. All right.
Thank you.